Welcome to Carry Trade Part 2, presented by Daily FX Education. In the first video, we introduced the carry trade. We explained that a carry trade was simply a trading strategy where a trader looks to gain not only capital appreciation, but also interest payments or rollover. We made the process of finding a carry trade relatively simple, recommending that traders locate one or two currency pairs whose interest rate differentials were the greatest. To locate these pairs, we recommended that traders scan the roll S and roll B columns of the simple dealing rates window of the platform to find pairs that offered the largest rollover payments. We then stressed the importance of choosing a pair whose long-term trend was in the direction of the positive rollover payment for that pair. For example, you can see here that if we bought the Aussie dollar, we would earn $3.67. This is a carry trade to consider as the long-term trend of the Aussie dollar is up, or favorable for buy positions. Finally, we concluded the video by discussing trade management. Although rollover payments are crucial to the carry trade, blindly choosing pairs to trade only because of the rollover payments offered is not the best way to locate solid carry trading opportunities. In this video, we're going to go much deeper into the factors that make for a good carry trade. We'll begin by discussing supply and demand and interest rates, and talk about how these can often determine the outcome of a carry trade. Because interest rates are so important, we're going to discuss a few ways to detect when an interest rate environment for a particular pair might change. Finding out what current interest rates are can be as simple as visiting a source like dailyfx.com, where central bank rates are posted daily. However, knowing what the interest rate outlook is, or what interest rates will be in 1 month or 6 months from now, is not as easy, but it's certainly just as important. In fact, it's probably more important, as you'll come to see later in this video. After discussing supply and demand and interest rates, you should have a solid fundamental backdrop, so we'll move on to discuss different market conditions that foster successful carry trades. We'll talk about risk appetite and how to gauge it properly, as this too is a very important factor to understand. And finally, we'll conclude with some specific carry trade examples, so you can get a better feel for what to look for as a solid carry trade develops, and we'll briefly touch on a few trade management techniques as well. As time is valuable, let's get started with our first topic. One of the first ideas taught in economics classes is the basic law of supply and demand, and its impact on markets. Money constantly flows in and out of different markets, driven by supply and demand for particular assets within those markets. But why? What causes certain markets to be more favorable than others? Why would someone choose to invest in market A versus market B? Of course, there are likely a number of reasons why, but typically, markets that offer the highest return on investment will generally attract the most capital. Think about a savings account for a moment. If you were considering opening a savings account with either Bank A, who offered a 2% annual rate, or Bank B, who offered a 0.25% annual rate, which one would you choose? Assuming all other factors were equal, of course. I assume it would be Bank A that offered you a savings account with an annual return of 2%. I know I would. In almost all cases, investors look to earn the highest rate of return while taking on the least amount of risk. And even though you may not have considered this previously, this is also the case for countries or a country's economy. In the world of international capital flows, nations that offer the highest interest rates generally attract the most investment and create the most demand for their currencies. If a particular economy is performing well, then it is able to offer investors a higher return on investment. Another way to make this point is to say that countries with better growth prospects can offer to pay a higher rate of interest on money invested with them, and with this, capital inflows are usually seen. Countries that have low growth and productivity are not able to offer investors a high rate of return on investment. In fact, there are some countries that have such weak economies they are unable to offer any return on investment, meaning that interest rates are zero or very close to it. In these situations, capital outflows are more likely seen. As a result, a carry trader needs to be aware of the general trend or health of the economies involved in the trade. Now, we've mentioned this before, but it is necessary to once again stress that not only are current interest rates important, but so too are future or expected interest rates. Therefore, we have to go beyond just determining where rates are set today. We can establish a better idea of where interest rates might be heading by watching certain pieces of key economic data. Economic news releases like gross domestic product, consumer and producer price indices, current account figures, employment figures, income and retail sales figures, all of these things will help paint a picture of a country's health. These releases over the course of many months can mold a central bank's view and direction of interest rate policy. For example, consider the condition of the United States at the time of this writing. Interest rates are currently near zero at 0.25%. Due to unemployment being above 10%, it's unlikely that the Federal Reserve will raise interest rates anytime in the near future. Although U.S. rates really have nowhere to go but up, analyzing a number of U.S. economic data points like unemployment don't suggest that rates will be increasing anytime soon. This type of analysis needs to be done for all countries that you consider for a carry trade, even those that have very high interest rates currently. Let's assume that a country had an interest rate of 6%, which is quite high.
Yet due to fundamental data, it's possible that the country would have to reduce rates soon to help stimulate their economy.
It's highly probable that money would begin to flow out of this country, not into it, due to the interest rate outlook. So even though the current rollover payment to buy this currency would likely be high, it would be very likely that the country's currency would depreciate over time as capital flowed out of it, working against the carry trade. In general terms, you should be interested in investing in an economy that is experiencing strong growth, high productivity, low unemployment, and rising incomes, because these tend to have higher interest rates or expectations that rates will be higher in the future. Keep in mind the fundamental data that impacts future interest rate expectations can take months, sometimes years, to develop. So it's important to watch the long-term direction of a country's fundamental position in lieu of being concerned with the day-to-day fluctuations that might occur. Additionally, the target interest rates set by central banks also move rather slowly. Therefore, interest rate changes typically happen slow as well. Once a particular direction is established, rates tend to move in the same direction for several months to possibly many years. Here's a chart depicting the interest rate movement of the 8 largest developed countries. You can see that the rates don't oscillate up and down regularly, but rather they trend for some time. Thus, carry trades are intended to be long-term investments. A trader must be willing and have capital to keep a trade open for an extended period of time. The carry trade commitment filters out the noise of short-term currency price movements. To summarize, the key to an effective carry trade is matching a country with increasing interest rate expectations against a country with decreasing interest rate expectations, as you can then earn the interest rate differential, while likely also earning capital appreciation as the healthy country continues to receive inflows of capital. Now, when to use the carry trade? It should now be clear that fundamental data, which leads to interest rate expectations, is very important to monitor. But let's now move on to talk about trading psychology. Carry trades work best and are most profitable when investors as a group have a specific attitude toward risk. Let's explore this idea a bit further. When investors as a whole are willing to take on risk, they have what is called low risk aversion. These investors are in a risk-seeking mode. On the other hand, investors who are not willing or interested in taking on risk have what is called high risk aversion. These investors often seek to avoid risk at all costs. Carry trades are most profitable when investors have low risk aversion and have an appetite to take on risk. With that statement, we're suggesting that a carry trade can involve risk. But why? We just spent a number of minutes talking about how countries with strong economies, low unemployment rates, and steady growth will subsequently offer higher rates of return. So why would it be risky to invest in a strong economy? Well, at face value, it shouldn't be, but there are a few things that you should always consider. Although in today's day and age, it's not highly likely that war or economic turmoil will veer their head quickly or unnoticed, these events can and do happen. And with them comes risk. For example, as strong as the United States has been over most of this century, it's also been involved in a number of wars and is currently desperately trying to recover from a major economic recession. This situation, as previously mentioned, has caused the Federal Reserve to reduce interest rates to 0.25%, and many other countries have had to follow a similar path. These moves have undoubtedly caused capital flows out of the country. But wait a minute, even if rates will fall due to things like war or economic turmoil, or even simply a slowing economy, doesn't it still make sense to put your money in a higher yielding currency, at least until rates drop below another country with higher rates? This is a good point, but it doesn't consider that the carry trade is concerned with more than just interest rates. Remember, it's not so much current interest rates, but future interest rates that investors watch closely. So if rates are dropping, investors will prefer to put their money with a currency that has a lower interest rate so long as its interest rate expectation is flat or on the rise. Now, you still might be thinking to yourself that something doesn't seem right. You can do simple math, and you still think it's best to stay with the higher yielding pair so long as it's higher than the rest. After all, you'll get the best return. But don't forget, the carry trade is built on earning interest and capital appreciation. So even if you're the bright investor that wants to stay with a high yielding currency, let's consider what happens when many other investors pull out and move on to alternative options. When this happens, we have capital outflows, or the selling of the high yielding currency. With selling comes falling rates, and herein lies the problem. You might still earn 6% or 5% or whatever it may be, but due to the capital outflows and all of the selling, you're likely going to lose significantly as the pair's exchange rate moves against you. So we can't just be concerned with current rates. As rates fall, capital will typically flow outward, causing rates to move against your carry position. An important thing to take away is that countries with higher rates have more room to fall if conditions change, and this is really where most of the risk lies. Looking back on these charts showing interest rate movements over the past several years, you can see the countries with the highest interest rates just prior to the credit crisis of 2008 had the furthest distance to drop in response to the crisis. And looking at their respective exchange rates, significant devaluation can be seen in many cases. Therefore, during times of duress, investors flee from countries with high rates to countries with already low interest rates, as these countries do not have room to cut rates nearly as far. And subsequently, their exchange rates will likely not depreciate as significantly either, if at all. Now, this is not to say that a carry trade is always risky. If things are going smoothly, a carry trade is a wonderful strategy to employ. All of this talk about risk and risk appetite is simply to make you aware. It's important to be conscious of the market environment and to investor psychology. Let's look at a few examples of what can happen when investors become risk averse. Before the 2008 credit crisis, the yen was the lowest yielding currency. After the crisis hit, the mood of investors shifted to high risk aversion, and as a result, investors took their money out of high yielding currencies to place them in lower yielding, safe haven currencies like the yen. This change in risk appetite is clearly reflected on a daily chart of the pound yen, for example. In the summer of 1998, the yen appreciated against the US dollar by over 20% in the span of 2 months, mainly due to the Russian debt crisis and bailout of hedge fund long-term capital management. Similarly, just after the September 11th terrorist attacks in the United States, the Swiss franc rose by more than 7% against the US dollar over a 10-day period. Sharp movements in currency values occur when risk aversion quickly changes from low to high. When risk aversion shifts, a carry trade can just as quickly turn from being profitable to unprofitable. In more recent times, the US dollar and its safe haven status benefited from a tremendous inflow of capital from around the world. In July of 2008, the US dollar index gained 24% in 4 months as the worldwide credit markets began to freeze up. International investors flocked to US treasuries, which meant they needed US dollars to buy these treasuries. A few months later, in response to several central banks adding liquidity to their currencies, risk appetite returned to the market and the value of the US dollar index fell 16% through 2009. For the carry trade to be successful, it's important for investor risk aversion to be low. How can we know if investors have high or low risk aversion? Unfortunately, it's difficult to measure investor risk aversion with a single number. One way to get a broad idea of risk aversion levels is to look at DailyFX, or www.dailyfx.com. Each Thursday, the research analysts at DailyFX produce a carry trade and risk report, where they assess various tools that provide insight to the market's risk appetite. The analysts developed a carry trade index which operates similar to a stock index. Based on the behavior of the carry trade index, we can form an idea of the market's risk appetite relative to the preceding weeks. As the carry trade index increases, this can show how risk appetite was on the rise. There are several other indicators also included in this report used to forecast the risk appetite of the market. These include the Daily FX Volatility Index, risk reversals, and interest rate outlook. The Daily FX Volatility Index measures the general level of volatility in the currency market. Since carry traders need low risk aversion to be successful, when volatility decreases, a drop in the index can be advantageous to carry traders. On the flip side, as volatility increases, so does risk aversion, and thus carry trades are more prone to failure. The risk reversals is another volatility measure. The risk reversals looks for the difference in volatility between similar FX call and put options. When risk reversals are skewed to the downside, it suggests volatility, and therefore demand is greater for put than for calls. Remember, as volatility increases, so does risk aversion, and carry trades tend to sell off. Forecasting rate decisions are notoriously speculative, yet the market can be efficient at predicting rate movements. To take advantage of the collective wisdom of the market to forecast rate decisions, the interest rate outlook portion of the article uses a combination of long-term, short-term, and risk-free interest rate assets to determine the cumulative 12-month projection of a central bank's exchange rate. This particular report, including the Reserve Bank of Australia, or the RBA, was chosen as the Australian dollar is one of a few currencies still considered to be a high yielder. Another tool commonly quoted during the 2008 credit crisis was the TED spread. The TED spread, or TED, is the difference between 3-month futures contracts for U.S. Treasuries and the 3-month contracts for euro dollars. When the spread between U.S. Treasuries and the LIBOR rate increased, this indicated risk aversion on the part of investors. As the credit crisis began to calm down, the TED spread began to drop back down to levels enjoyed before the crisis began. Now, we've covered a lot of information up to this point. We've talked a lot about how to locate a good carry trade opportunity and what things a carry trader should watch out for. To fully understand and interpret what was covered, you'll need to start looking over and familiarizing yourself with the reports and economic data points that we've discussed. Let's close this video by jumping into some charts to see how we would actually approach entering a carry trade position. And we'll conclude with a tip on trade management. Let's look at a daily chart of the Aussie yen in November of 2008. We notice a series of lower highs and lower lows, indicating the trend is to the downside. Yet the direction of the carry is up, since Australia has a higher interest rate than Japan. In this case, the direction of the trend and the direction of the carry do not match up, so we wait for prices to create an uptrend because we want to trade in the direction of our carry trend, or in the direction of rollover. Several days later, prices drop and bounce higher, creating a higher low. Based on prior price action, we'll want a higher high to establish above the former November 4th price level around 70. On January 6th, prices move up, then begin to drop. However, a higher high was not created, so we continue to stand aside from this trade. On February the 1st, another low is created that's still above the low from October. Again, we wait for the higher high to be created so we know that the uptrend is beginning to be established. On April 1st, we get a daily close above the 70 price level, creating a higher high for the pair, which is what we've been waiting for. This gives us the green light indicating the daily trend has now moved to the upside. Now we wait for a technical reason to enter the trade at a better price. We connect common areas of support and draw a support trend line and wait for the prices to retrace to the trend line to enter the carry trade. On April 28th, prices reach the support line and we enter the trade going long near the price of 68. We place a stop below this trend line at around 65.5. On July 7th, the daily candle closed below the support line and we exit the position near the price of 75, about twice the distance of our stop. In this instance, not only did we earn the carry interest, which would amount to approximately $34, but our trade gained through positive appreciation of the exchange rate, or capital appreciation, of nearly 700 pips. Had we arbitrarily entered a trade, there are several points where we would have sustained significant capital losses as the risk was greater while the trend was still in a downward direction. Let's move on to one more carry trade example, this time on the Aussie Swiss. In November of 2008, prices went through a series of lower highs and lower lows. Positive rollover on this pair is gained when we buy the Australian dollar Swiss franc pair, as Australia's interest rate is higher than Switzerland's. So at this time, we need to wait for a higher high to be made, which will take this downtrend to an uptrend. Then and only then will our carry and trend direction be aligned. On April 9th, prices close above the old high, creating a new higher high, which again is what we're looking for. If we wanted to take a more aggressive approach, we could open a trade on the break above this level near 83. Over the next several days, the prices begin to drop. Because we're aggressive, we ended up in losing position for the first couple of weeks. Fortunately, since carry trading is a long-term strategy, we can hold these positions open for several months, utilizing a wide stop of several hundred pips. Now let's close this video with a money management technique that often works quite well with the carry trade. There are several different money management techniques you can employ, but I'd like to talk about the manual trailing stop, which means we adjust our stop price if the market moves in our favor by a specified amount. Because carry trades are typically long-term strategies, trailing stops can oftentimes be quite helpful, and here's how they work. Let's say we opened a position on April 9th, 2009 on the break above the previous highs. We then notice there's a swing low near the 78 price level, so we decide to place a stop just below the support. That's approximately 500 pips below our entry price. When manually trailing your stop, you first need to decide how far behind the price you want your stop to be. If you trail your stop too close, you may have less risk, but you leave your trade susceptible to getting stopped out early. If your stop does not trail or follow the price close enough, then you run the risk of having a winning trade possibly turning into a losing trade. Many traders look to the distance between their entry and stop as a starting point. In our case, the stop is 500 pips away from our initial entry, so we decide to manually trail the stop in chunks of 500 pips. Other traders, who may want the stop to move quicker, may choose a smaller variation like 250 pips. But for this example, we'll move our stop 500 pips in our favor each time the trade moves 500 pips in our favor as well. On June 11th, prices move up 500 pips, so we move our stop up to break even. Now, even if the trade turns against us and hits our stop is now our original entry price, so we hopefully won't lose anything on this trade even if we get stopped out. On July 13th, prices retrace down, but they do not hit our stop. Even if our stop had been hit at break even at this point, we still would have earned interest during the trade, which wouldn't necessarily be all that bad. But prices stayed above the stop price and eventually moved up to 93 on October the 8th. To lock in capital gains, we moved the stop up to 88 and remained in the trade until our stop was triggered. Carry trades are long-term investments. A trader must be prepared to enter into a trade for months or even years. A trader can profit from the difference between the interest rates of different countries with little risk as long as he pays attention to the market climate. We hope you found the material in this video helpful, and we encourage you to attend a live webinar on carry trading with our course instructors. In the webinar, instructors will relate what you've learned here to the current market conditions. Instructors will also field live Q&A on the topic of carry trading. Thanks for watching this video, and we look forward to seeing you in the live webinars.